Hello and welcome to the How to Trade Like a Pro podcast. I'm Wieland Arlt, and in this episode I tell you a little bit about the 5 most important things to be a successful trader. Before we start, please take a closer look to the risk disclaimer in the show notes and now enjoy this episode. Welcome to the 5 key factors for profitable trading success. My name is Wieland Arlt. I'm a CFTE. Now, if you ask yourself, what is a CFTE? It's a certified financial technician, and not just because of that, but it was one factor that opened the door for myself. That later on, after the certification, I became the president of IFTA, of the International Federation of Technical Analysts. And therefore, yes, we are responsible for the certification, and we take care of the technical analysis. So that's one part of my profession. I'm a trader, of course. Otherwise, it would not make sense to discuss trading as well. So, and I've written several books. One is about risk and money management, and I am one of the partners for cooperation partners for Cyber Trade as well. And therefore, welcome again, and let's discuss why 90% of all traders fail and what are the key factors that determine success or failure. And I'd like to say some of them are not just only valid for trading, sometimes they appear in life as well. So how about this one? Of course, there's something like some kind of disclaimer. So what I like really make sure is that, of course, what I present to you are some of my personal thoughts about how trading can be better, can be more successful, and therefore it's more an impulse, right? Just to think about your trading, just to think about also what you are doing in the markets with Cyber Trade, or maybe also with your own account. So whatever you're going with, that's basically the idea to discuss. Now the question is, why do 90% of all traders fail? And honestly speaking, in real life, in the real world of trading, it's even more. And what is failing anyway? Failing usually is that if you start trading back in the days, you just needed to open an account, fund your account with your own money. And usually people don't have so much money, right? So therefore, they feel a lot of pressure in being successful from scratch, from the very beginning. Problem is that there is no room for beginning, and there's also no room for beginning mistakes as a trader. As you start from the very first trade on, you're in a competition with the most professional guys in the field, in the industry, and they're just waiting for you. Actually, they don't know you, and actually they don't see you, but what they see is what you do in the markets, how you act, how you react, and where you act. So this means there are a lot of traps and pitfalls hidden in trading, and that's also something to be aware of. And most of the pitfalls and traps are hidden in ourselves. So that's something we always have in hand, no matter whom we are competing with. It's all about ourselves as well, and not just starting with a perfect strategy. And the question is if it really exists anyway, or the perfect behavior in the market. So that's something really worth to be discussed, and not just in this setting, but also in general, just to make sure that we fully understand about trading. So that's very, very important as well from my point of view, right? Now, why do 90% or even more of all traders fail? That doesn't also mean that they fail for good. So let's say about why do they, first fail. Maybe fail with their own account, so they get broke in their own account, or fail in their competition, right? And therefore the challenge and cannot master it, or lose their funded account because of some mistakes, whatever they did, like risk management mistakes, something like this. And yes, of course, you always can come back. You can come back with your own money, but you also can come back with a funded account. Of course, that's possible, but at least it's annoying, isn't it? So you better avoid failing, losing the account, no matter what your account is. If it's funded by yourself or funded by Sabio Trade, it's always annoying, right? So people usually don't want this. Yes, we can come back and we can return and we can always make it. Yes, it's possible, but the question is if we can avoid it, right? And that's why it's very, very important to discuss this. So what might be the reasons? So usually if you look at yourself and maybe also if you discuss with others, studies is one thing, but experience, and I'm full of experience after 20 years in the markets, 20 years of learning, but also like more than 10, almost 14 years of teaching as well, and coaching, trading. So what are people missing? Discipline. And here you have it. It's not about the other ones. It's about ourselves. So starting with discipline, it's number one. Poor risk management, that's the second thing. Poor risk management for sure is one of the main reasons why traders fail, why they lose their account. Over leveraging, it's something you always have to be aware of, because over leveraging is nothing else but having a too big position for a single trade, right? Just moving too much money. And if that one goes against you, you're done within a couple of seconds maybe. Over-analysis, analysis paralysis, right? So you look at the chart and all of a sudden you see everything. You see a lot of entry signals, you see a lot of why not to trade signals, you see a lot of signals why you should trade, and therefore you start questioning everything that you do. And therefore it's also something to think about it. Why not keeping things simple, like KISS? Keep it simple and stupid, right? So this principle is quite true. I know, especially if people start as a trader, they tend to put everything in their chart just to make sure you have a lot of things just moving and blinking and up and down and back and forth and stuff. But at the end, if you really are into this, you realize that trading is almost about the price and yourself. So yes, we might use some things which can help us in the analysis, but if we overdo it, we will not go any step further. And of course, a lack of structure. Lack of structure means how do you organize yourself? So self-management is something always to work on. And this is not just true for trading, it's true for the whole life. If you're not able to manage yourself in a certain way, you end up in chaos. I mean, we don't have to go deeper here, right? Now, let's go into these 5 factors I like to present. Of course, there are more, but we can discuss those. So just as an overview, they are very, very important and essential in practice and in these trading environments we're living in. So again, discipline and emotional stability. There you have it. Emotional stability is the key. And it's pretty easy to understand why. Because if you feel like I'm not emotionally stable, I cannot cope with drawbacks, I cannot cope with the market telling me no, rejection, stuff like this, So how can you deal with losing trades without going mad over them? And discipline means, yeah, of course, we have to wait for the right signal. And this means that depending on the time frame you're in, that you're sitting in front of your screen for hours, if you're a day trader, and without doing anything. And this is what a lot of people cannot deal with. So discipline is one thing, not doing anything because there's no sign, there's no signal, there's nothing. And then discipline also is that you sit and wait in your trade while it's going, just to have your position be not just executed but closed, either with a loss or profit. And also this is discipline. Solid risk and money management. We're definitely going to discuss this one. I wrote a book about this, and right now I'm about to record a training course for Savvy Trade, together with Savvy Trade, and I'm going to talk a lot about risk and money management. So yes, this is one of the biggest factors for trading success. If you have a solid risk management and you have let's say, a drawdown, a series of losses, you will survive. But if you don't have, you might have one loss and you will be done. So that's why it's very, very important to understand this. Especially if you think about, you have a 6% loss rule with funded accounts, but also in the challenge. And it's very easy to say, okay, I just risk it, but then the account is gone, right? So if you want to keep it, if you want to stay in trading, if you want to stay in the game, so you need to have a solid risk management. And therefore, like all the rules, people like to say, yes, maybe you're going to risk 1% of your capital. Might not work here, right? Because it's way too much. Imagine you have just 6 trades going the wrong direction, you're done, right? So definitely that's not the point. And maybe this is something to be discussed as well. A structured trading plan and also trading routines. Routines also for yourself, daily routines. When do you start? When do you end? Things like this. A structured trading plan means that you have, let's say, a set of setups, of strategies. You're always looking at in the chart and waiting for the signals to come. And then you execute, following your plan. And sounds like you need some discipline for this as well, because you just follow your plan. It's some stuff coming from the social media or from media in general. Psychological awareness and inner trader development. Now what's that? Again, we're talking about psychological factors. It's not just emotional stability, discipline, stuff like that. It's also that you are aware of what is going on with yourself. If you have, like, let's say, fear, or if you tend to be greedy, or if you get nervous, if you question yourself, or especially your trade. This is psychological awareness. And inner trader development means, of course, we need always to work on our mental strengths. Because out there in the markets, life is challenging. Friends, it's very challenging because everybody wants to get in your pocket. Everybody wants to have your position size. Everybody wants to have your money. Everybody wants to have what you are willing and need to risk. Everybody is after that. Like you and me, we are after those. That's what it is, right? And therefore, yes, we have to prepare ourselves for this. And of course, and that's why I'm happy that you're here watching together with me, going with me through these points, continuous learning and also strategy reflection. Yes, there are very solid strategies out there which go for ages, like decades, almost centuries, right? So like candlesticks, for example, they're coming from the 16th century. So therefore, they have just kind of, they have some kind of track record for sure. So, but still, we have to look at them and see and question ourselves, do they work in this environment, in this very moment? Or do I have to go for something else? Do I have to use something else? And therefore, continuous learning gives you the ability, to put a little bit more into your toolbox for that moment when you really need it, when you need something else out of your toolbox, because the market environment changes. For example, right now, we have totally crazy markets going like immediately, within a minute, a couple of hundreds points up and down. Look at the indices, look at S&P 500, NASDAQ 100, look at the DAX, look at all the other indices. They're going crazy. So therefore, if you're not prepared for this, if you're not prepared for, let's say, breakout trades, for pullbacks, for high momentum trades, well, these markets happen without you, right? So therefore, continuous learning is very, very important, as well as having some strategies in hand and being able to change them the moment we need. Now, let's go more deeper into these 5 factors. Now, let's start with discipline and emotional stability. Yeah, gut feeling. What is gut feeling, by the way? Now, it says successful traders do not trade on gut feeling, and it's true, because if you just have gut feeling, you make quite uninformed choices and uninformed decisions. So it's like, Yeah, I had some coaching calls with people like, yeah, I have a feeling the market might go up, and of course you can be lucky and it goes like this, but most of the time it's not about luck, it's about knowledge, right? And therefore gut feeling definitely is not something to rely on. It might add a little bit of, let's say, spice to to go with the gut feeling. But in general, gut feeling is something which comes from experience. Because you know what it is? You look at the chart and you see that the chart is moving into one direction, let's say up, and it's going, let's say, to a resistance area. And then you feel like, yeah, I have seen this so many times. And I have the feelings this might be a false break to the upside and then the market might reverse. So I prepare myself for a short trade, right? So this might be something about gut feeling from experience. But in general, for us in the markets, we need to follow a clear plan. So why is it? Because if we don't have a plan and emotions come in, we get totally out of hand. So we are acting because of emotions, but as traders, we cannot afford this. So a plan, and this is why we need the discipline to follow this plan, to say, okay, I have these setups and I have these strategies, and the moment, and that's very important, the moment I have a situation where I'm getting challenged, let's say you open a trade and the trade goes against you, but your strategy says you have your stop loss, your cut loss, let's say below the previous low, where it's supposed to be. So nothing is there to do, but you already get emotions because you're a human being. And this is like, oh, I'm afraid I'm going to lose that trade. That's fear. But still you follow your plan because you say, no, it's part of my strategy that I risk that amount of, like that percentage of my trading account, what I can afford for this very trade, and I just give the market the room it needs to move. Because I'm following my strategy. If I like it or not, it doesn't matter, because I have decided myself to follow the strategy. So that's part of the decision. So we follow a plan, we follow everything which is happening right here, right? So therefore, it's very important to have this, and not just the gut feeling. Oh, I feel like this trade might fail. You don't know anything, and we don't know anything. The market does what the market does, and we're just following our plan. And if we had made our homework, the plan will succeed in the long run. So therefore, self-discipline is most crucial, especially when we are on losing streaks like drawdowns. And this will happen. And still we have to be able to execute the next trade, because it's part of our plan, it's part of our strategy. We say, okay, I have the next candlestick signal coming in, and I'm gonna execute the next trade according to my strategy. I choose my position size, I choose the right risk amount. That's why it's very important to have really a low percentage of the trading account, because we might have, and we will have, a losing streak once in a while. And this means 1, 2, 3, 4, 5, maybe 6, maybe 7 losing trades in a row. That happens. And therefore, we need to follow the plan. Say, okay, I reduce my risk, I protect my account, and when the next situation comes in, I execute again. Because this trade might be that one that brings everything back. The problem is we just know it afterwards. We just know it in hindsight, right? So again, this is as an example. After 3 losing trades in a row, we look, of course, at the trade and step back a bit, give a little bit time, but we follow the plan, right? And if you don't have the plan, if you're just impulsive, you just open a revenge trade, maybe have a higher, that's also very common, a higher position size just to make it back in a very short amount of time. Just the next trade needs to deliver everything back and even more for the profit. And this is devastating. So it's very very important to be aware of this. So don't do any trades just because of revenge or frustration or greed. I want to have more. No, follow step by step, follow your plan. And that's one of the most important things. So discipline and emotional stability, they come together, right? Because if we don't have discipline, how can we be emotionally stable? It's barely possible, and vice versa, right? So therefore, they complement each other. So some kind of maturity is needed. How can we do this? Routines, journaling, mindset work. It's crazy, right? I don't show you a chart, not one chart in this presentation, but still, these things are most important for our development as a trader. We're not always talking about strategies. There are countless strategies out there, but it's more important to follow your own emotional development, right? Risk management, position sizing, I love that one for a simple reason. It's a key. Management is a key, from my point of view, of trading success. And of course, a successful trader defines a risk per trade, for example, 1%. And this is most common out there in the trading world, especially for the people who trade with their own money. It's not appropriate if you have like 6% risk in total loss of the account, and then the account is gone and the challenge is gone and you need to start all over again. Obviously, right? Because if you go with 1% in a funded account, or also the challenge, you need 6 trades and you're done. So maybe it's already happening with 5 trades, because then you are already just back to the wall. So that's not what it is. So it might be 0.5, might be 0.25. And then you're sitting there and feel like, oh, wait a minute, I am aiming for a $100,000 funded account. I cannot go with 1,000. I just can go with 250. I could do this with my own money, right? And that's not the point. The point is that you get enough money to do trades where you can also have a higher position size, but a very, very tight stop loss. And that's the point where most traders fail, right? So that's something to discuss as well, to think about. So therefore, the definition of the risk is more important and determines the position size. And that's something always to be aware of. That's why we need a proper account size, right? To have the possibility to do these trades. So that's something to do, and always to discuss in percentage of the account balance. And of course, without this, you just jump in the trade. You will have a lot of psychological stress, because what happens then is, if you have a too high position size and therefore maybe no stop loss, which is always disastrous, or a too far away stop loss according to your position size, you get a lot of stress. And what happens then is that if the market goes against you and you experience a loss in your system, like in the book, not realized so far, but in your book, we see that we get stressed. We experience stress. And the situation then is that we tend to disturb the trade. And that's even worse, right? Because at this very moment, we disturb the trade. We might close the trade without anything just had happened, just because we cannot we cannot cope with that stress. And that's how we, make our own losses without being necessary. Also something to consider. So, and also we have to be aware that long-term success in general isn't about winning every trade. It's not possible, basically. So people tell you, hey, I win every trade. I don't think so, that we should take them really serious, because every trader makes losses. And the question is how you deal with losses. How do we deal with the losses? Which impact do the losses have for our trading? And that's more important. It's not a big deal to have losses. It's a big deal to have small losses. Because if you have small losses, you can have like a couple without really affecting your account, and also you're staying in the system and also in the program, right? But if you have just a few losses, but they are big, you're out immediately, or you may be out immediately. So therefore, it's about the protection of the account. It's the protection of the money over the time. And we all have situations where the market is not according to our strategies, or take it the other way around, where our strategies are not proper working in that market environment, right? So therefore, if we have proper risk management, that doesn't affect the account so much. So never risk more than 2% per trade. Again, this is a rule of thumb. I suggest for funded accounts with that loss rule, never go higher than 0.5. Stay below 0.25, 0.3. This might be the proper risk amount to go with. And yes, I know this is bad news for all guys want to go like really quick and really fast, but it's what it is, right? So it's like a marathon, it's not a sprint. We need to stay in trading for a long time, because that's what we do as traders. This is our living. This is what we do for a living, and therefore you don't want to be in and out within a couple of days or weeks maybe, right? So therefore, that's very, very important to apply. And yes, if you don't have a stop loss, you're just barely professional, you're gambling. And therefore, if you don't have any money management, capital management, you're not in business, you're in trouble. And that's very, very, very important to understand. If you don't manage this, you're done. Sooner or later, you're done. And that's true for all kind of accounts. Funded, your own account, whatever you're going with. If you don't apply these rules to your trading, game over. You're in trouble, for sure. Now, of course, with Savio Trade, we have a strong emphasis on disciplined risk management, and therefore there are clear rules, just to discuss this as well, that traders must follow to successfully trade with Savio Trade's capital, right? So there's a daily loss limit, 5% of the previous day's account balance. That's what it is. So, for example, if you have an account balance of 100,000, the maximum daily loss allowed is 5,000. The problem is, if you're at 4,000, well, you're almost done. Yes, there's some little room to move, but the probability that you will get this as well, the last 1,000, is very high. So, and again, of course, like just by the mathematics, you could go like, okay, let's go with 1%, but it's gambling. It's nothing that's with professional behavior, right? So again, if you're like 0.5, 2.5, 0.3, something like this, you give yourself room for losses. You give yourself room for mistakes, and there will be mistakes no matter what. I make mistakes myself every day, maybe. And the same is true for all the other colleagues, professional trader colleagues I know around the world. And this is something we always have to be aware of. So yes, there might be just small steps to success, but at least these steps, they are sustainable and we can follow them on a daily basis, and that's even more important. The maximum trading drawdown, here we have the 6% of the highest achieved account balance. So there's a high watermark in place. So the value adjusts dynamically and includes both realized and unrealized losses. So that's even more important to understand. So if you have a private account, so trading with your own money, you might give a trade a lot of room because you feel like, it's okay, I can refund myself. But you cannot give this room for movement as an unrealized loss with a funded account with Savio Trade, or actually any other firm, right? Because if you go too deep, the risk that you are below the 6, like more than the 6%, is too high. So therefore, that's what it is. It's not needs to be realized. It's just sitting there in the book, and you're done. Right? So that's very, very important to understand. And also here, we're talking about risk management, and it's the key. If you don't apply risk management, game over, once again. And in all means. Profit target, yes, there's a profit target for the evaluation. So if you want to go with a challenge, so yes, 10% profit without breaching the above mentioned risk limits, obviously. And actually 10% sounds pretty easy, like, yeah, I just do, let's say, I just do 10 trades with 1% risk. But the probability that you will fail with these numbers is too high, right? So, because you might be lucky, but in the long run, no. So it takes a while to get the 10%. And it's okay, because it's not about rallying, it's about being consistently profitable. That's what trading is about, no matter what kind of account and what account size. And there's a trading activity requirement. Yes, of course, just blocking the account, it doesn't make any sense at all for nobody. So at least one trade every 30 days just to keep things going is advised, and obviously makes sense, right? So therefore, these rules are for both. So for the firm, for Cybertrade, and also for yourself to stay sustainable in your trading career, right? And it makes sense, right? It definitely makes sense if we finally understand that trading is a profession to be followed and not like some fun activity, then we are already on the path of success. Now, structured trading plan and routines. A clear plan prevents impulsive decisions. I mean, obviously. So what is in your plan, by the way? Of course, you put something into this like how to analyze the market. What elements do you use for the market analysis? You want to go with just some kind of Dow theory, or you want to go with, let's say, support and resistances, or you want to add something fancy, something like this. Maybe you want to go with Ichimoku, something like this, or volume profile. So whatever you like, it sits in your trading plan. So that's how you analyze the market. That's what you're looking for. Then you need to define an entry criteria. If you want to go with breakouts, okay, what kind of breakouts? If you want to go with pullbacks, if you want to go like me, I'm more like not a counter trend trader, but I'm a counter move trader. By the way, basically most of us are counter move trader as we are going for the turning points, right? So that's the entry criteria. Like you want to maybe look at candlesticks. You want to see maybe a hammer, shooting star, stuff like that. So this is part of your trading plans. This is part of your strategy. What is the risk you like to take over? Is it 0.2.5, 0.5 maximum? Something like that. This is part of a plan. You always take this. And it's very important to stay consistent there. Because if you have like, today I for this trade, I go with 0.2.5. Next trade, I go with 0.5. The other trade, I go with 0.3. It doesn't lead to consistent results. It's very, very, let's say, choppy then. So you have a little bit more higher profits, you might have higher losses then, and you have a mixed bag of results. And to be consistent, you need the same risk amount in percentage of the account. What is the exit strategy? And if you feel like, what is an exit strategy? I just let the market run. You might feel like that if you don't have an exit strategy, that you might end up in a loss after you had a huge profit, and then you find yourself break even or even in a loss. Why is it? It is because if we don't have an exit strategy, are sitting in a trade which is going up and down, and as the market moves, we are in a profit, we are break even, we are in a loss, and so on and so on. So I've seen this a million times maybe in my life, and also especially in my own life, because it's always the same question: when do I exit the trade? If I exit too early, I might have just a very small profit. And then I look at the chart and see what I have missed. Hey, welcome to the greedy situation of being a trader. Or if I exit too late, I might maybe miss the highest point as an exit and maybe just leave the trade because I already lost in the book like 50% of my profit and it's gone. And before I go break even, I just take the small trade. So therefore, there's not really something we feel like this is the perfect situation. It always needs to be perfect for ourselves. That's at least what I feel about trading and about exit. An exit is not just when you take the profit, it's also when do you take your loss, right? So where will be, it's part of the strategy. Will it be below the low of the candle you were entering or above, depending on the direction? Or will it be below the lower low or whatever, So you need to have a definition of where you take your losses, and you need to have a definition where and when and why you take your profits. So you can have a lot of ideas there, like double risk-reward ratio, something like this, or the next resistance area, or the next support area, or that one after, or you scale out, right? You scale out one part of your trade with a risk-reward ratio of 1, the second one with a risk-reward ratio of 2, and stuff like that. So it's all possible, but we need to make a decision before we make the trade. And this is part of this structured plan. That's why it's called structured plan, right? And of course, post-trade review. So this is something like journaling. A lot of people forget this because it's boring, honestly speaking, right? You find yourself being a bookkeeper and you just want to be a trader. You just want to make some money in the markets, and then you sit yourself like with an Excel sheet, or you write some notes in a book, and it feels like, I don't want to do this. I'm not a bookkeeper, I'm a trader. But as trader, you're also a bookkeeper. You have to see what you have done. You have to reflect. You have to reflect also not just your results per trade, but also your behavior, your mental state of, your state of mind, your mental, state, whatever. So how you are trading, how you felt while trading, your stability, how you felt like greed, fear, all of that is very important to review, to learn, to grow. Trading can be very challenging, especially for ourselves when it comes to this, to face also our weaknesses as human beings. I don't want to be too philosophical right now, but it's part of the development and evolution of a trade as well, right? So therefore, post-trade review, don't take it too light. It's very important. Maybe you want to do a screenshot. Where did you enter? Where did you exit? Why? Right? And then you learn from this. And this is how you get a structure plan. That's how you also can grow as a trader. Yeah, winning traders have routines, like athletes or pilots. There's a movie. There are a lot of movies. Look at, Michael Jordan, these series, or I'm a basketball fan, by the way. Maybe just sounds like it. Or there's a movie about Dirk Nowitzki. It's called The Perfect Shot. And it's really impressive because, like Dirk Nowitzki, as we all know, one of the best athletes out there, at least has been. I think he's retired right now. And it was about, they had like a tournament. And after this tournament, this guy, he went together with his trainer into the next training session, right after. For what? Just for practicing even more. Just to learn even more, just to get a little bit better, just to make the difference. So there are routines, there are training routines, there are just routines for warming up. Maybe you want to warm up as a trader as well, right? So this is something also to take into place. So the routine that gives us clarity, focus, and reduce decision fatigue. It's also something to be aware of. As traders, we always have to make decisions day in, day out. We have to make a lot of decisions. The shorter your time frame is you're trading in, let's say you trade in a 1 minute chart, really fast. You see all the moves coming in. You're in constant decision-making mode. You have to make a decision. Shall I enter this trade? If I want to enter this trade, what will it be based on? What is the position size? What is the entry point? What is the exit point? Where is the profit taking point? what is the position size according to the stop loss, and everything like this. And this is happening within a minute or a fraction of a minute, within a couple of seconds. And that's very, very, very challenging. It makes us fatigue. And basically, it's like you're an athlete as well. And that's what we always have to consider. So you cannot do this the whole day. Just imagine, you start like 8 a.m. morning, and you end up like 6 p.m. In the evening, and you've done in a 1 minute chart all of this. Maybe you're familiar with that one, right? So you have to make constantly decisions. Wow, it's really exhausting. So therefore, usually we can do this like 60, 90, maybe 120 minutes, like 2 hours, and that's it. And we're almost done for the day. We're tired. We're exhausted. We get some kind of fatigue. So, but having a routine makes it easier. We don't have to think so much. We just have to check our list like a pilot, Okay, brakes, check. Engine, check. Door closed, check. You know what I mean? So it's the same like with trading. Trend, check. Candlestick, check. Breakout, check. Right? So it makes things easier. This gives us clarity, focus, and reduced also the complexity of being a trader. So the structure suggested, and just a nutshell here, pre-market to analyze what is going on overnight, because it's pre-market, right? So usually we start in the morning, whatever morning it might be, but so what happened before? Where are we going with the chart? What is going on the weekly chart? What is going on the daily chart? Where are support and resistances? What kind of trend am I looking at? Up, down, sideways, right? So this is part of the analysis. Where might be the reaction points for the market? Where might be the reversal points? So where are the points I get interested as a trader in? I want to be part of it. We can see this earlier. We don't have to react just only that. We can also be part of it as we feel like I can prepare myself for these price levels. Maybe put an alarm somewhere, right? News scan. What happened with Donald? Something new going on. Something like this. What's going on in the economy-wise? What is going on in my country, in the market I'm trading? What is going on with Forex? What is going on in China, for example? What is going on, the big countries who are always like, what's going on in Europe? What is going on in the US? What happened? What are people talking about? Maybe you want to see some numbers from companies. If you go with this, if you go with crypto, okay, what is going on with MicroStrategy? Did Michael Saylor bought again? So things like this. That's what we want to see. We want to check maybe a watch list if we have it. If we go for stocks or forex pairs or stuff like that. So we want to look at the watch list. What happened there? Where are the marks here? And then when trading time is, you already know what you what are you looking for, what is waiting for you. You can imagine that if you see in the news that, Donald Trump, he just mentioned tariffs once again, you can be, for trading time, be prepared for high volatility in all directions, right? So that's pretty obviously. And therefore, yes, when it's trading time, you know what is waiting for you. And then you can execute with focus and maybe discipline. You can also choose some ideas of a strategy. So let's say you go again, okay, there's some volatile session coming because of this news. You go with momentum strategies and not so much with counter move strategies, because they might fail because of the high volatility, and also maybe people just like running into one direction without even having a pause. So therefore, these strategies might fail, but we can prepare ourselves beforehand if we do pre-market our homework, right? And then we can just go with focus and discipline as a trader. And post-market, yes, being a bookkeeper, review, journaling, lessons learned. It's very important also. I do this all the time. And it's true also for life. What did I learn today? Where did I had good behavior? Okay, well done. Where did I had not so much good behavior? Okay, I can work on this, and I need to work on this. Good behavior as a trader is obviously just to follow your plan, staying disciplined, staying focused, and do this what you have like already planned to do. Like the price is coming to the area, you wanted to take action, at least you wanted to look at and see what happens in order to, to see if there's an entry point. Then there's the entry point, you execute your trade as you have planned, and the trade fails. So, nothing wrong. You just were following your plan. Lessons learned, okay. Yes, I did what I needed to do. It was a loser, but that's okay because you were following your plan. We cannot push the market in the desired direction. Unfortunately, that's not possible. But we can make sure that if the market goes with us, we become profitable, and if it goes against us, we don't lose too much. Right? So that's what it is. This is one of the lessons to be learned. Now, success factor, I think it's number 5, it might be 5 anyway. Psychological awareness and the inner trader. So, what is this about? Now, the inner trader, developing the inner trader requires, of course, reflection. If just numb, if you run numb through the markets and through life, don't feel anything about yourself, don't reflect about yourself, you will not be successful by any means, right? So, because we always need to reflect ourselves. It's like you're in contact with other people, and you don't greet anybody, so don't expect to be successful in life if nobody really is in contact with you, right? Or you don't interact with other people. So how can this work? And the same is true as well for the market. So we need to reflect our actions. What have I done? How was my execution? How was my execution of my trading plan? How disciplined have I been? Why did I fail maybe in discipline? Why did I get greedy? What can I do against it? Stuff like this. So mindset training, conscious self-regulation is something we are doomed. I see this, I say this on purpose. We are doomed to do this on a constant basis, day by day. Reflect ourselves, train ourselves, question ourselves, question our actions, question our ideas, question how we do trading. It's not so much about question your strategy all over again, because if you have a solid strategy, it will be solid for a couple of years maybe, or maybe forever. But it's always important to question yourself. And yes, emotions are natural. We are emotional beings. We all know, right? So we have our emotions. We have love, hate, fear, greed. We are brave. We have everything. So they are natural. It's good that way, actually, right? But in trading, our emotions can be dangerous because they block our actions. They make us do things we don't want to do. Same like in real life, but in trading, they might be very costly. So if emotions kick in, like, let's start with fear. We are afraid of the losing trade, of the loss. With fear, what might happen? It might happen that you take away your stop loss just to give the market a little bit more room because you don't want to realize the loss. And now we're talking about the 5 or 6%, like watermark and unrealized losses. There you go. Right? So don't do this. What else could happen when we have fear about losing money? We make it real. I know what I'm talking about because this is what happens. So you sit in the trade goes against you. The trade is something that annoys you. You feel like, why are you doing this? I don't want to go deeper in my loss. And you close the trade in the middle of everything, right? So your stop loss isn't touched. Yes, you're not break even anymore, but still there are probabilities, and these probabilities are in place. These probabilities are that the market might still follow your idea, right? That's why you do an analysis. So, and if you close your trade in between because you are afraid of losing this trade, losing money, it's a trading mistake by definition, right? Revenge trades, they come with this as well. Now I show you who is the strongest guy here. Not us. for sure not the trader, right? So that's something very, very important to understand. Don't do revenge trades. Don't, it's very common that people just jump in back after a losing trade with a higher position size just to revenge this, just to come back with a bang. The problem is the bang usually happens to the other side and brings you even deeper in the red zone. Greed is also a very problematic emotion in general, but in trading, especially in trading. That's why you want to have more of your profit. You're in a trade and you just want to milk it. I know there are a lot of traders out there want to do this, and it might work from time to time. But in general, if you hunt for more, you will most likely end up with less. And that's lessons learned from 20 years of practice, because everybody wants to have more, right? I mean, that's part of our life. And still, situation is that, in the hunt of more, we end up with less or nothing. That's a problem here. So therefore, greed is very dangerous and might be one of the reasons really people fail, because they just want too much in too low time, right? So therefore, that's something to be aware of by ourselves. And by this, one bad emotional decision can wipe out a week of disciplined profits. And it's not just that I just wrote it down because I heard it. No, I write it down because I know it. And yes, I did it. I not just did it once, I just wanted to make sure that it's true, to experience it several times. And it happens, and I can definitely say this, it happens to all of us once in a while, to all the professionals as well. Because we're human beings, right? So that's why, again, we're talking about risk management, that we make this. Oh, by the way, I was discussing with a poker professional. Poker and trading is quite close, right? Because it's both very challenging, especially from the inner part, from the mental side. And I said to him, in poker there's this tilt where you freak totally out and you just put all the money in. And I asked him, as a professional, do you still have this tilt? Or is it gone? And he said to me, yeah, we have it. We have it like all the other ones, but we realized earlier that this is coming and that we stop playing. And that's true for professional traders as well. With a little bit more experience, you see, you feel what's coming. And I just can tell you one thing, just get up, leave the station, close everything, leave the stations, make a break, maybe for the day, maybe for the week, depending on the time frame you're in. So that's something to learn. So as tools, what you can learn or what you can use, of course, mental journaling, make some pauses, make a break after some losses, maybe not just after one loss, because you might be a little bit too early with your entry. The market just gives you a false move. So these things happen. But if you see that the market and your strategy are not a perfect match in this very moment, it makes definitely sense to have a break and go to maybe after lunch or after coffee, and you return, maybe market environment already has changed, and then you can re-enter. Then you are fresh again in your mind, and the market might be in a different condition or start next day. And also, I like this, reward yourself for following your plan, not for a winning trade. These are two different things. You can have a losing trade and still having a reward for yourself in place because you were acting right. Because one thing is for sure, a losing trade always can be bigger without any management. And therefore, if you act right, if you act the right way, if you act according your plan, your strategy, what you are willing or just planning to do, you're good to go. So reward yourself, whatever it might be. Have a coffee, I don't know, maybe you want to have a beer, go for a spa, whatever, right? So reward yourself, and you also enjoy your profits. That's also something which is important. So what good are profits if you don't live from them, right? And the key question is, in general, did I follow my plan regardless of the outcome? And if you say, yes, I did, I had a losing streak because the market environment was not a perfect fit for my strategy right now, or vice versa. But still, I was disciplined with my position size, and still I executed the trades as they were coming, but simply was not the time, then that's perfectly fine, right? So, because you don't know beforehand that you will have a winner or loser. All you know is that in general, your strategy is profitable, or should be. So here's some psychological traps and also their solutions. So if you have the problem of overtrading, what is the cause? It's impatience. So if you have a structured plan, if you have a checklist, so why should you overtrade? Because if you don't have the signal according to your plan, you don't trade. And if you still have too many signals, maybe you want to go higher in your time frame. Revenge trading is nothing else but frustration. And how to cope with frustration. Just take a break and write it down. That you read it, that it sits just in front of you. You always have your eyes on it. You're like, no revenge trading, no frustration. Have a break, have a coffee, have a snack. You know, perfectionism is just nothing else like the need for control. And in trading, the only thing we can control is the money we lose under normal market conditions, obviously, right? Not talking about the black swan, but that's the only thing we can control. If we are wrong in our trade, that's what we can control, that we lose $100 each trade, right? That's something we can control. Or 105 is a bit slippage, but you know that's not the point. So what we need to accept is that trading is always about probabilities, period, nothing else. It's about probabilities. That's why we do technical analysis, by the way, to have the highest probability for our trade. You know, to find that trade with a higher probability, because there's only one question we need to answer, seriously, as traders. And this question is, in what direction might the market go in the next session, next minute, or next candle, with the highest probability? And if you find the answer to this, we're good, right? So, trading is not something you master just like on a weekend, a few months. The market evolves, we should do so. We are bound together as traders, right? So we are part of everything. There's no market without traders, there's no trader without a market. So the market evolves, we need to. As a professional, we always reflect. We track our statistics. We learn from our mistakes. We reflect weekly, maybe daily, depending on what happened, right? And we adapt, we try. It's a journey. It's not just about getting rich quick, even though media sometimes tells us that story, as it sounds sexy, but it's more about the inner development. So we adapt over time to what's going on in the market to become better as traders, and maybe also as humans, who knows. So invest in learning, read, review, join a community, go for a coach. Maybe at least just for discussion, to check on your strategy, whatever. And also remember, every loss is a feedback. Mistakes are also a data. If you make a mistake, this happens, but if you make a mistake, learn from it, right? Learn from, okay, next time I use a stop loss. Next time I have a lower position size. Next time I wait for the candle to be finished to do my analysis, right? And how to do some kind of reflection. This is the money management matrix. I introduced this one in my book about risk and money management, and also I have this in that video course we will introduce soon. So it's about risk-reward ratio, it's about the trading frequency and the hit rate. And if you, in your reflections, feel like your hit rate is too low, maybe you want to go with a lower risk-reward ratio, just to have a higher hit rate. This means nothing else that you are a little bit more humble, take your profits a little bit more early and therefore by definition might have a higher hit rate. Or for example, you feel like, oh, I have like quite a high trading frequency. I should work on my risk. So I need to lower my risk, because if you have a high trading frequency, by definition, you have a high risk in total, right? Because you have a lot of trades, and therefore you might have a lot of losers and a lot of winners, of course. And if you do so, look at your risk reward ratio, right? So if you have like coming to a hit rate, let's say 50% or 40%, yes, you need to have, especially if you have lower than 50%, you need to have a little bit higher risk reward ratio. Because the make or break level of hit rate and risk reward ratio is 50%. So if you have a hit rate of 50% and you have a risk reward ratio of 1, you don't do anything, right? Nothing happens by definition, because you end up 0. So one of these things need to go up, which one ever you will see, right? It's a question of the strategy and the question of management. But if you look at these 4 factors, if you look at these 4 points, you have a good probability to grow, right? This is something you can use for growing. Now, I see I'm already just over the time. Now, these 5 factors are the foundation of professional trading. So they replace, I really like it, they replace hope with structure, emotion with clarity, and chance with repeatability. I'm German. So strategy gives us clear rules for entries, exits, and trade management. Risk is to protect capital and also think long-term. Psychology means know yourself, manage your emotions. And structure means daily routines and preparation. And last but not least, learning is review, adapt, grow. To sum it up, trading success isn't luck. Those who master these 5 factors build a solid foundation, whether as retail, with your own account, or prop traders. No matter what, you need this. You need to master these factors and even more. And this is just a foundation. And for both professions, both ways, that's what we need. So thanks for watching. Thanks for joining. Hope you like it. And I hope you return for the next session with me, but also with the colleagues. All the best to you, and see you next time. Your Wieland Arlt. That's already it, and I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of all these links you find there, and then I will be happy to hear and see you again. Your Wieland Arlt.